Let's understand the significance of adequate working capital through the slide. It's a short one, but it explains a lot of points to you. We have been talking about the concept of working capital, the introduction to working capital, and we have more or less been talking about the same things over and over. Now, this slides also re-emphasizes on certain points which you've already covered, and obviously takes you through a few more new points. So. Let's look at this here. Yeah, so this is about the solvency of the business. Okay, research and innovation shows up here, but let's take it towards the end. So, significance of working capital, it's solvency. It ensures solvency of the business. I already discussed this with you in the previous slide, wherein it's like this. There are certain factors which affect the business directly, and there are others which affect it indirectly. By the very fact that the business is going on smoothly, in fact, a lot of things fall in place, and solvency of business is one of them. In fact, if the short-term payments, if the daily operations are all going on well, or it ensures it gives a lot of comfort to the external parties, and it puts less pressure on the books of accounts, and hence it helps in the solvency of the business. Cash discount, I already discussed this. Whenever you have payments getting done on time, the vendors give the business cash discount. Goodwill of the business obviously is a reputation of the business, which gets built up with good working capital management. Then liquidity. Yes, liquidity, as I said, solvency. When liquidity is amplified, is when we get to solvency. So liquidity is also liquidity also ensures timely payment of obligations, if at all, especially to the lenders. Easy loan, when the book is in shape, working capital is well managed, the lenders would also like to extend loan to the business. Meeting unseen contingencies, yes, that also comes true when you have liquidity, when you have well managed working capital. Uh, any unseen contingencies can be met up well. Regular supply of raw materials, which may possibly get hampered because of deficient working capital, and high morale. When everything goes well, the morale of the employees is high. They are charged up. They're excited to work. Regular payment of commitments, that happens automatically. I discussed this when we were discussing solvency. Good relations with banks and financial institutions. Of course, Easy Loan itself specifies that banks and financial institutions hold the organization in high esteem, and they want to maintain relations with that particular organization. Exploitation of favorable market conditions. Whenever there's a market condition which is in your favor, your when I say in your favor, it means in the business favor. The business would be in a position to exploit it timely and make the best out of it. Increased fixed asset productivity. Fixed asset productivity increases because you are able to utilize its potential to the maximum because of better management of working capital. Research and innovation program. Okay, ability to face crisis. Well, quite well understood. I don't think I need to spend time on it. Research and innovation program. When the daily operations are going on well, it gives time to the organization to focus on research and innovation as well. So, well, I hope that makes the significance of working capital to clear to you. Thank you. This session will try and explain to you the evils of excessive or inadequate working capital. Well, it may sound good to have excessive working capital because that may lead you to think that the organization will have enough money to take care of its liquidity position, to take care of its solvency, to take care of its payments, and all in all, it sounds good. But yes, there are flip sides to excessive working capital, and let's see how. Working excessive working capital also means idle funds lying, which is an interest loss to the company. The company cannot earn a proper rate of return on its investments because of interest loss, and because the funds are not getting utilized in any productive in any productive activities. And then there can be an unnecessary purchase of inventories in the bulk by the organization. Uh, there can be a question mark on the company's goodwill, and it can also affect the share price of the company. That's because the company is not earning a proper rate of return. There is an interest loss. That's and that can consecutively affect the share price and the turnover ratio. So the moment the turnover ratios of the company look bad, the lenders will probably shy away from lending to the company further, if at all there is a need. And then higher incidence of bad debts, of course, because lesser working capital may also mean that the company is not really having a proper credit recovery system in place. And so the people who have to, or the customers who have to pay to the company haven't paid yet, and that can subsequently lead uh, to bad debts. More spend, morality can be a question. If the company spends without thinking, that can question the morality of the employees and the managers of the company. What is it with inadequate working capital? Now, how is that? Of course, anything which is inadequate obviously has its own drawbacks. Let's understand here how what's the case with working capital. Growth will be stagnated, obviously. We know the reason, because of the shortage of funds. Goodwill again of the company gets hampered, good gets tarnished in whatever case, and objectives of business concern cannot be achieved because the working capital is not enough. The company is not able to conduct the activities which it had thought of. Short-term liabilities cannot be met in time. Short-term liabilities cannot be met in time, of course, because there are shortage of funds. Fixed assets will not be used because we do not have funds to use the potential of those fixed assets. Cash discounts cannot be availed. Trade discounts also cannot be availed. Production capacity is not used fully. That is what it means by saying that fixed assets cannot be used properly, because there are no funds to use the potentiality of fixed assets. Liquidity position of a firm becomes a question mark, and hence the credit worthiness of the company gets decreased. The moment we talk about credit worthiness of the company getting reduced, it also puts a question mark on the borrowing capacity of the company, and that can lead to bad performance. I hope this is clear. Thank you. Let's understand the determinants of working capital management through this session. Well, we will look at each of these determinants one by one. The credit policy. The credit policy of an organization means the policy that it has designed for giving credits and for receiving credits. When I say giving credits, it means that for increasing, or for the debtors in place, and for receiving credits for the creditors in place. So that basically determines the working capital. If the credit policy is like really tight, then working capital requirement is less. If it's very loose and flexible, the working capital requirement may be high. The company is required to strike a balance between the two. The growth rate. Now, the growth rate means at what rate, how aggressive is the growth plans of the company. Obviously, high aggressive growth plans mean higher working capital requirement. Payables and payment terms. It more or less gets covered as a part of the credit policy. Still, payment terms means the terms uh, on which company pays to its suppliers. They can have different terms with different suppliers, and that defines the working capital. Production process flow, how long it takes, what all is involved, what is the working capital requirement in the production process, how long it takes for the raw material to get converted to final product, and so on. The seasonality of the business means if the business is seasonal, the requirement of working capital goes up during the season, and it will not be the requirement will not be as much when the product is not in demand. Well, that's about determinants of working capital. Thank you. Well, what are the sources of working capital? What are the sources through which one can raise working capital? One organization can raise working capital. Let's understand that through this presentation. Uh, I have packed it up in one slide for your easy recall. We will talk about each of these sources. We will spend time on each of these sources separately. Now we have spontaneous sources. which means as and when required, short-term sources and long-term sources. Now, this is not a very hardcore classification, but yes, this is a classification we normally adopt for classifying the sources of working capital. Now, let's start with the spontaneous sources. Now, these are the sources which are very temporary sources of working capital. Trade creditors, which means when they pay up, the company gets working capital. Trade creditors are the creditors, which trade creditors, as in the people whom the company has to pay in the later date. The company has involved is involved into a business with certain suppliers and has not paid immediately, so they become the trade creditors. Similarly, sundry creditors. So when if you're not paying the company cash at the time when you bought a material, you are obviously generating that as a working capital. And as I said, this is a very temporary source of working capital. Similar is the case with sundry creditors. Now, bills payable, again, the same thing. If you're not paying the bills now and you are postponing or deferring the payment for future, then you are using that money. When I say it means the organization is using that money to act as the working capital of the organization. Similarly, for notes payable and accrued expenses. What are accrued expenses? Again, a very short term and very spontaneous source of capital, which is like deferring the payment. Accrued is something which you are likely to pay, which you are supposed to pay, but you haven't paid for some reasons. It may be due to the understanding with the individual to whom you have to pay, with the entity to whom the organization has to pay, whatever reasons. That is accrued expense. Now, that expense has incurred because you've taken services, but you've not paid for it. That money is also acting as working capital for the business. Those were the spontaneous sources. Now, short-term sources, internal sources, tax provisions, dividend provisions, all kind of provisions, which means you have deferred the payment. All kind of provisions created provide temporary source of or short-term source of working capital for the company. By creating provisions, you are primarily not paying the money immediately and you are deferring it for some time. External sources, bank overdraft. Now, bank overdraft primarily means where the bank gives the facility to an organization to withdraw more money than the organization maintains in its savings account, in its bank account. Now, that is the simplest form of overdraft to be understood at this level. So that's what is bank overdraft. So let's say your account has 100 rupees and you have the bank has given you a power to use 150 rupees. You are overdrawing the bank account by 50 rupees more, and that's kind of a loan which the bank gives to you and charges interest on it. Then trade and public deposits, the same thing. Bill discounting where you are the organization is producing the bill for discounting by the banks, and against that receiving money. That is also a source of working capital. Now, what is bill discounting? I would like you to refer to sources to understand what is bill discounting. Primarily, these organizations get the bill discounted by the banks and get their working capital from the banks. Now, long-term sources include retained profits. They are any time source of working capital for an organization. Depreciation provision, again the same logic that we had spoken about in case of dividend provisions and tax provisions. External sources are share capital, long-term loans, which is self-explanatory. So these are, all in all, these are the sources through which an organization can raise working capital. Well, that's for now. Thank you. Let's understand what is cash management through this session. I will take you through various slides which will describe you the importance of cash and cash management in the organization. Well, what do we understand by cash in a narrow sense? We all know what is cash. So you all are familiar with the explanation on the left-hand side of the slide, which is narrow sense, cash in hand, that is currency, notes and coins, which we all are aware of. In the broader sense, it means cash and its equipments. That is cash at bank, short-term investments, which means cash and cash equivalents. Okay, we also call them as cash and cash equivalents. We also call them. We also sometimes include marketable securities also here, which are short-term investments, which means investments which can be liquidated, which are short-term, and if need be, can be liquidated immediately to generate money. Okay, though that is also considered the cash in a broader sense. Uh, what is cash management? It is the optimum utilization of cash to ensure. Now, what is cash for? Cash is basically liquidity. So that's why we say to ensure maximum liquidity and maximum profitability. It refers to the proper collection, disbursement, and investment of cash. Please understand that maximum liquidity does not ever mean that you should that a company should sit on a pile of cash. Okay, that's very dangerous. That's detrimental for the organization because the company is not doing anything but leaving its resources idle and hence incurring a lot of loss. It is also not good that the company does not have any cash balance in its records. It's a challenging task for the managers to strike a balance between the two. That is where it says to ensure maximum liquidity. It should be ideally maximum permissible liquidity and maximum profitability. Liquidity in such a way that the profitability of the company is not hampered. And that is where there is a planning is required in terms of proper collection, disbursement, and investment of cash. The objectives of cash management: fulfill working capital requirement, which we have already discussed of so far. Planning capital expenditure. Capital expenditure means expenditure on fixed assets or expenditure on all those resources which give the organization long-term benefits. So those are planning of capital expenditure. Handling unorganized costs which do not come with a notice, and the ones which are unforeseen. Initiates investment, obviously. Proper cash management initiates investment, better utilization of funds, and avoiding insolvency. So we have been talking about a company being solvent and liquid for the past couple of slides now. So I'm sure you'll appreciate the importance of cash management as avoiding insolvency. Better utilization of funds, yes, as I just now told you that excessive cash and no cash, both the situations are detrimental for an organization. So these are the objectives of cash management. Um then we have functions of cash management. Functions of cash management means investing of idle cash. I just now discussed about it. Controlling cash flows. Now, cash flows in an organization through primarily three different activities: operating, investing, and financing activities. It is essential for us to have a control. Now, control does not mean that we have to stop the flow of cash, but we have to have it in a controlled manner. Planning of cash, obviously. Managing cash flows, which are controlling and managing probably can be clubbed into two, because controlling becomes a part of managing cash. Optimizing cash levels in such a way that we do not fall short of liquidity in the organization. At the same time, we do not affect the profitability of the organization. Now, these are the few functions of cash management. Thank you. Yeah, well, this pack of slides is about receivables management. Uh, for you to understand what are receivables, I am receivables are the uh, yeah the is are basically receivables is a term which is used for the money which an organization is likely to receive, is expected to receive for the sales that it has made, sales of product or services. That's what is receivables. And the manage now you would be surprised to know why, to kind of fathom why this also requires management. This does require management because uh, sometimes organizations sell their product and services on credit, which means they give the product or the service to the customer, but they do not ask for the money then and there. That happens in the deals which are bigger in size, and they're very common for an organization who does large scale dealings. Okay, it may not happen with customers like you and me, but it happens with customers who are who get into large scale dealings with the organization. Management of these receivables is important for the organization to ensure that its money comes back to them and the business goes on well. So it incorporates management is it's all about ensuring that customers pay their invoices, as I just said. It helps prevent overdue payment or non-payment. When it becomes a non-payment, it gets converted into a bad debt. That's for your information. It is therefore a quick and effective way to strengthen the company's financial and liquidity position. What is its important? importance, the company tends to lose everything with poor receivables management. Imagine you have sold a product or service to the customer and you haven't got the money. So, what could be more unprofitable than what can be a bigger loss for a company than this? It involves much more than reminding customers to pay. It's also about identifying the reason for non-payment and acting on those reasons. Okay, so good receivables management is a process which consists of knowing the customer in advance. You should know what are the customer intentions, and that happens by knowing the customer's credit rating in advance, frequently scanning and monitoring the customer for credit risks. So if you have known the customer for his credit rating, and if the customer's credit rating is good, that does not mean that the customer cannot default on the payment. So it's essential that the customer is scanned and monitored frequently. You have to keep the customer relations alive so that the organization is in touch with the customer, and any changes happening, favorable or unfavorable, happening at the customer's end, are well known to the organization. Detecting late payments and complaints in due time, reducing the total balance outstanding. That's very important for the organization to do. By reducing that, basically, the organization is able to recover its debts on time. Preventing any bad debts. As I told you earlier, that any debt which is not recovered for a certain time period gets converted into a bad debt, and a bad debt is a black mark on the financial books of accounts of the company. So to avoid that black mark, it's very important for the company to do a proper receivables management. I hope that this gives you an overview of receivables management. This is all for the slide. We will talk about inventory management in the next slide. Thank you. Yes, this pack of slides will take you through inventory management. I hope you all are aware of what is inventory. Inventory is the stock of finished goods. It can also be the stock of raw materials of an organization. We are using inventory here from the perspective of stock of finished goods. In fact, the management of both kind of inventory is required for that matter. Let's understand what are the objectives of inventory management. Well, that means preventing dead stock or perishability. It is very essential for the organization to maintain uh, a particular stock of inventory at a particular time. The stock of inventory being maintained by the organization cannot be taken lightly, because excessive inventory leads to dead stock, or if the product is perishability. It also involves a lot of cost, because one, the organization incurred cost in buying the inventory, and second is in storing the inventory. In both ways, organization incurred additional cost. Maintaining sufficient stock is very important, as I just now said. It also should ensure cash flow. Cash flow, which means it should not be lying unsold. Then the organization should also try reducing the purchase cost of goods. There are various ways to do it, and there are various quantitative methods to figure that out, which is not covered as a part of your syllabus. But I'm sure as you go along, you would cover those methods. Now, purchase cost of goods can be reduced by say by buying quantities in bulk, or by asking for a cash discount, or by asking for a trade discount. These are for some of the ways. There can be other ways too. What are the 5 benefits of inventory management? Keeps track of your inventory and offers a centralized view of the stock. Controls your cost by making stock reports for analysis of your inventory. Improves delivery by managing stockouts and meeting customer expectations. Manages planning and forecasting by analyzing data trends, and reduces the time for managing inventory by keeping records in place. So I'm sure all these points are self-explanatory, so I'm not getting into the details of these points. They explain what they primarily mean, and these are the benefits because of which it's essential for the organization to do inventory management. Well, thanks for now.